The art of risk management, essential for traders. Reducing losses is facilitated by risk management. Additionally, it can aid in preventing traders' accounts from losing their whole balance. Losses for traders represent a risk. Traders can increase their chances of success in the market if they can control their risk. It is a necessary but sometimes disregarded precondition for profitable active trading. After all, without an effective risk management plan, a trader who has made significant profits could lose it all in one or two poor deals. So how do you create the most effective strategies to reduce market risks? In this video, we'll go over a few easy ways to safeguard your trading gains. Making a trade plan. Sun Tzu, the renowned Chinese military commander, once stated, "Every battle is won before it is fought." This expression suggests that strategy and preparation, not combat, win wars. Likewise, successful traders frequently use the adage, "Plan the trade and trade the plan." Similar to warfare, forethought can frequently spell the difference between victory and defeat. Make sure your broker is appropriate for regular trading first. Customers who trade seldom are catered to by certain brokers. They don't provide aggressive traders with the necessary analytical tools and charge exorbitant commissions. Take profit and stop loss points are two essential tools that traders can use to prepare ahead while trading. Proficient traders are aware of their willingness to buy and sell at different prices. They can then compare the likelihood that the stock will achieve its objectives with the ensuing returns. They carry out the transaction if the adjusted return is sufficiently high. On the other hand, losing traders frequently enter a transaction without knowing when they will sell for a profit or a loss. Similar to speculators riding a profitable or unprofitable streak, feelings start to control and direct their trades. Profits might tempt traders to foolishly hang on for even greater gains, while losses frequently prompt people to hang on and try to get their money back. Think about the 1% rule. Many day traders adhere to the so-called 1% rule. Essentially, this general guideline advises against investing more than 1% of your trading account's value or money in a single transaction. Consequently, your position in any particular instrument shouldn't be greater than $100 if you have $10,000 in your trading account. This is a typical approach for traders with accounts under $100,000. If funds permit, some traders even use as much as 2%. Many traders with larger account balances might decide to use a smaller percentage. This is because the position grows together with the amount of your account. The rule should be kept at 2% as this is the best approach to limit your losses. If it is higher, you will be losing a significant portion of your trading account. Establishing take profit and stop loss points. The price at which a trader will sell a stock and incur a loss on the transaction is known as the stop loss point. This frequently occurs when a trade does not turn out as the trader had anticipated. The points are intended to stop people from thinking that it will come back and to stop losses before they get out of hand. For example, traders typically sell as soon as a stock breaks below a critical support level. A trader's take profit point, on the other hand, is the stock price at which they will sell and turn a profit on the transaction. At this point, the additional upside is constrained by the associated dangers. For instance, investors would wish to sell a stock before a period of consolidation occurs if it is getting close to a significant resistance level following a significant upward rise. How to establish stop loss points more effectively. Technical analysis is frequently used to determine stop loss and take profit levels, but fundamental analysis can also be very important in timing. For instance, as anticipation for earnings builds and a trader holds onto a stock, they could wish to sell before the market hears the news if expectations have become too high, even if the take profit price hasn't been reached. The most often used method for determining these points is to use moving averages since they are simple to compute and are frequently monitored by the market. The 5, 9, 20, 50, 100, and 200-day averages are important moving averages. The easiest way to set them is to apply them to the chart of a stock and see if the price of the stock has previously responded to them as a level of support or resistance. Using support or resistance trend lines is another excellent method for placing stop loss or take profit levels. By joining prior highs or lows that happen on a substantial above-average volume, they can be found. Finding the points at which the price responds to trend lines or moving averages and, of course, the large volume is crucial. Here are some important things to keep in mind when setting these points. For more volatile companies, use longer-term moving averages to lessen the likelihood that a meaningless price swing may cause an execution of a stop-loss order. To match target price ranges, adjust the moving averages. For instance, to minimize the quantity of signals produced, longer objectives ought to employ larger moving averages. Stop losses should be avoided if they are less than 1.5 times the volatility of the current high to low range since they are more likely to be executed arbitrarily. Adapt the stop loss to the volatility of the market. The stop loss settings can be tightened if there isn't much movement in the stock price. It is an important window of time to enter or exit a trade when volatility and uncertainty are likely to increase, such as known fundamental events like earnings announcements. Finding the expected return. To compute the predicted return, stop loss and take profit points must also be set. It is impossible to overestimate the significance of this computation, since it compels traders to consider and justify their trades. Additionally, it provides them with a methodical manner to evaluate several transactions and choose only the most lucrative ones. This computation gives the active trader an expected return, which they can compare to other possibilities to decide which stocks to trade. Experienced traders can estimate the possibility of profit or loss by examining past breakouts and breakdowns from the support and resistance levels, or by speculating. Blend and protect. Never put all of your eggs in one basket if you want to maximize your trade. You're inviting yourself to a significant loss if you invest all of your money in one concept. Don't forget to diversify your investments across market capitalization, geographic location, and industrial sectors. This allows you to take advantage of more chances while also assisting you in managing your risk. Additionally, you might need to hedge your position. When the findings are expected, think about taking a stock position. To strengthen your position and preserve your viewpoint, you may think about using choices to take the opposing stance. It is then possible to unwind the hedge when trade activity declines. Negative carry options. Purchasing a downside put option, commonly referred to as a protective put if you are permitted to trade options, can also be used as a hedge to reduce losses from a trade that goes bad. With a put option, you can sell the underlying stock at a certain price at or before the option expires, but you are not required to. Thus, if you purchase a 6-month $80 put option for $1 per option in premium and own $100 worth of XYZ stock, you will essentially be stopped out of any price decline below $79. $80 strike less the $1 premium paid. Active trading. What is it? The word active trading refers to the practice of consistently trying to profit from brief price changes. Purchasing stocks is not a retirement plan. Holding them for a short while in an attempt to capitalize on the trend is the aim. Because they enter and exit the market regularly, active traders are referred to as such. Which risk management strategies do active traders employ? Selecting the appropriate broker, pausing before acting, establishing stop loss and take profit levels, spreading bets, diversifying and hedging are some of the strategies used by active traders to control risk. What is the trading rule of 1%? According to the 1% rule, traders are not allowed to risk more than 1% of the value of their entire account in a single trade. It doesn't mean you can just invest $100 in a $10,000 account. It implies that a single trade shouldn't result in a loss of more than $100. How can I start trading actively and be successful? Understanding financial markets and being conversant with the different instruments used to read price movements are prerequisites for being a successful active trader. Along with having enough time and money to trade, you also need to be able to control your emotions. The secret is to have a plan and to follow it. Additionally, if you want to succeed in the long run, diversify your wagers. Not everyone is suited for active trading. Contrary to popular belief, earning enough money to leave your day job is not simple or sure. Before risking your money, consider your options carefully. Start small and try simulating some trades on a test account. So this is the end of our video. Do you like it? Kindly give your valuable response in our comment section below, and don't forget to subscribe to our YouTube channel for more interesting and informative videos.